Hello everyone, I hope that you are well. In today's video, we're going to cover a very simple technique that has a 70+% accuracy rate in determining the bias of the price action of any given day using stocks, options, or cryptocurrency. We will be using one chart, and that's the daily chart. So I hope that you enjoy this. This content was taken as an excerpt from a video that was posted to the members of the Profit Market YouTube channel. I know that there hasn't been a lot of posting done on this broad channel here for several months, but I want to assure you that there are videos in the works under production right now that will be posted on this channel in the near future. So I hope that you enjoy this content. I hope that you find it valuable, and I hope that you consider liking, subscribing, and sharing this video. Enjoy. So before we get into that, let's just take a look at the quick disclaimer here. All right, so today's video, let's just review the concept. It's a very simple concept. I'll go over it several times if you don't understand it fully the first go round. So in a lot of my videos, I use the term bullish and bearish control. In this video, I'm going to say the words bullish and bearish. What I'm referring to is a bullish bias or a bearish bias, and how I define that looking at a single time frame. I will outline that here. So oh, sorry, went the wrong way with my slides. So if we take a look here, we have this red candle, all right? And then this is followed by a green candle. This is something that we can see on any chart. But the idea is that if you have a red candle followed by a green candle, if this green candle closes, and realize the close is up here. So the open is at the bottom of this candle, the close is at the top of this candle. If this green candle closes above the open of this most recent red candle, okay, and this red candle could be 2 candles ago, but in this instance, it's the candle just previous, then we are in what is known as a bullish bias, all right? And we would expect the next candle to also have a bullish bias, all right? So if we go from a red candle to a green candle that closes above the open of this red candle, and the open of this red candle is the top of the candle, because remember, red candles open and then they paint downwards and then they close here. So this would be a bullish candle that puts us into a bullish bias. So we would expect for the next candle to have that same bullish bias and not be a candle that closes below the open of this green candle. Clicking the wrong direction again. And so here's an example of the next candle that has presented itself, and this is still within the bullish bias. And these candles will stay in this bullish bias until a red candle closes below the open of the most recent green candle. All right, so this would be the open of the most recent green candle, and we will stay in a bullish bias, just referencing the candles prior to the current candle, until we switch into a bearish bias. Switching into a bearish bias looks just like this. So if we have a candle that trades and it closes, the close of this candle is the bottom. If it closes below the open, which I've shown here by drawing this horizontal blue line, we have now switched from a bullish bias to a bearish bias. And once we are in this bearish bias, we would expect the next candle to keep us in a bearish bias. And so even though this next candle is a green candle, it is still in a bearish bias because it is a green candle that does not close above the open of this red candle. It does not do what this previous green candle did here, switching us from bearish to bullish. So this green candle is still in a bearish bias. So let me say that one more time. Red candle followed by a green candle. This green candle closes above the open of this red candle. The open is right here, this horizontal blue line. That's the value of the open. We close above that. We are in a bullish bias. The expectation is that the next candle will be in a bullish bias as well. It is in a bullish bias. We will continue to stay in a bullish bias until a candle can close below the open of this candle here. But then here's something to pay attention to. If we get another green candle, well, then we would switch to the open of the next green candle, right? Because we're always referencing the most recent candle. So when we are looking at the red candle, we look at the previous candle here. This red closes below the open. We're now in a bearish bias. If you're not understanding this, we're going to go over this many times throughout the video. I'm just trying to get you to understand the basis for the analysis that I'm going to present to you in the following slides. This is a bearish bias, and we say that this green candle is also in a bearish bias because it has not yet closed above the open of this red candle to switch it into a bullish bias once more. So looking at the previous candles, what we're able to do is say, okay, well, if this candle's in a bullish bias, we expect the next candle to be in a bullish bias as well. What I'm going to show you in this video is that line of thinking will be accurate typically 70 to 75% of the time. Just this little exercise that I showed you right here is going to allow you to predict the next candle's bias 70 to 75% of the time. And that is a very valuable thing. I'll explain it further in this video. So if we go through and look at these candles, the way that we would grade them would be that this candle was accurately predicted by the bias. This candle was also accurately predicted by the bias because this was a bullish bias and this was a bullish candle because it did not close below the open of the previous candle. This candle turned us into a bearish bias, and this candle was still in a bearish bias as well because it did not close above the open of this previous red candle, which meant that the downward trading is still happening. So bulls did not come back in and take control back. And so if we're just looking at this green candle, our expectation would be that the next candle would have a bearish bias as well. Hopefully red in color so that it gives us a better trading opportunity. But the idea is that it's the next candle following this candle is not going to close above the open. And so following that type of logic, we would say that this candle was correct. This candle was correct, this candle was incorrect, and this candle was incorrect. Why? This candle is incorrect because we expected it to have a bullish bias. This candle put us in a bullish bias. We stayed in the bullish bias here, but this candle did not have a bullish bias. It switched us from bullish to bearish. So this was wrong. These were correct, and these were wrong when we're trying to predict the bias using the previous candle. All right, so running an analysis like that, I used the broad market tickers, and using the broad market, I just did a trailing 12 month starting from October 20th, 2021 and going back to October 20th of 2020 and going candle by candle on the daily chart and using the current candle and determining the bullish or bearish bias. It accurately predicts the bias of the next candle 76.28% of the time. All right, I'll show you that analysis on an Excel spreadsheet here momentarily. And that's pretty good, right? So just looking at a daily chart, we're able to determine the bias of the next day before it even forms with a 76.28% accuracy. We'll talk about the various ways that you can use that in your trading in the following slides. But the other thing that I really want to point out is that just because something worked in the trailing 12 months does not mean that it's something that's accurate in all market conditions. So one of the things that I do is I go back. Personally, one of my worst years trading was 2014. Why? Because I was using a lot of techniques in 2013. 2013, by the way, was a year where the S&P returned either close to 30%, possibly over 30%. My memory doesn't serve me well there, but it was a large market year, much larger than average. And so a lot of these bullish techniques, buying the dips and things like that, just arbitrarily worked really, really well in 2013. A lot of hedge funds did well. A lot of mutual funds did great. But what happened in 2014 was this massive amount of consolidation to where we had these up markets sideways, and then they'd go down, and then they go up, and then sideways. And I really got hammered. I did not do a good job in 2014 with my trading. I also was totally unaware of everything I'm explaining to you in this video. And a lot of what I'm explaining to you in this video was born out of the years where my trading just did not do great. But if you take this same technique that works 76.28% of the time in the trailing 12 months, looking at our broad market tickers, and by the way, just using the daily chart, no other charts. If you apply that same technique from 10/20/2013 to 10/20/2014, right? So that portion, that market year per se, it has an accuracy rate of 71.88%. So again, what does that mean? It means that in any given time, using the bullish or bearish bias that I've outlined so far, this technique accurately predicted the bias of the following candle 71.88% of the time. That is not bad. So then let's go to another difficult market year. So October 20th of 2007 through October 20th, 2008. For some of you new traders who haven't really paid attention to the economy over the last decade, this was the worst year in the stock market it's actually for decades, actually. But this was the housing crisis. This is where the markets were just deteriorating. They'd go sideways. They'd have massive sell-offs. This was a horrible year for a lot of traders. Yet this still returned, if you average it up, it's still 70% accurate. It's 69.57%. So even during this period of time, this technique, again, not doing anything else but just looking at candles on a daily chart, accurately predicted the bias of the next candle almost 70% of the time. So while it was not as quite as accurate, it's still a very good accuracy rate. But while it was not as accurate as some of the more recent market activity, the opportunity is greater because the volatility was so large. There was so much money to be made on the downside using puts and things like that. So a lot of these accurately predicted candles were huge red candles that returned hundreds, sometimes even thousands of percentage on options, but really, really good percentages on short equities or inverse ETFs and things like that. All right, so let's dive into some of those results just really quickly, and then I'll highlight on the chart some recent examples, some broad market examples, just to kind of really hone in and drive home the particulars of how this analysis is done, just so you can do it yourself and begin implementing this with your trading if you so choose. So here's the actual data that backs up the numbers that I presented in the slide previously. So what this is this is the trailing 12 months. I started this on October 20th of 2021, so this past Wednesday. And what I did was, if the previous candle accurately presented the bias of the current candle, then I put a 1. And if it inaccurately predicted it, I put a 0. All right. So and then I just so that you can graphically see the strings of wins, when they were accurate, I put a green box, and when they were inaccurate, a red box. So the way to read this is looking at the candles. If we had a price action chart, looking at the candles on October 13th of 2021, we had a bullish bias, correct? And so, well, I don't know about bullish, but whatever bias was there, that was probably actually bearish. Whatever bias was there was accurate up until this point, and then there was a candle that switched the bias, and so it did not accurately predict the next candle. So that would have been a day where we went into trading expecting a certain bias, and we got the actual opposite bias. And so what you see is we have these strings of wins, where you'll have like 9 days in a row accurately predicted. And then all of a sudden, you'll have a day that was not accurately predicted, followed by a couple of days of accurately predicted, then a day not, and then these strings. And sometimes these runs are really long. Sometimes they're not. Sometimes you have these areas of consolidation where it goes back and forth. So one day is accurate, the next day is not, next day is accurate, the next day is not. And these are essentially like consolidations in the market. But this is the data. So what happened in the past 12 months is we had 253 trading days. The bias was accurately predicted 193 times, 76.28% accuracy. Here's the range from 10/20/13 to 10/20/2014, just so you can graphically see. We have these runs of accuracy, and then you have times where it's inaccurate. So remember, 25 to 30% of the time, it's wrong. And that's just trading. But again, this is a very easy way to get a pretty substantial edge on the market. And again, I'm also not doing this analysis adding any other type of technical analysis or any of the tools that I've presented to you to help determine directionality of the market. And so what's here is a little section where the results are not that great for about 3 weeks, and then it straightens itself out. And then we have these good runs of results. This is a reason why I always tell people to put 10% of their account in the options trades, or not to go more than 10%, I should say. You can use less, and that would be totally fine, is because you never control the distribution of losses. So even though we have a statistical edge of, say, like 70 or 75%, we still don't know the distribution of that 25 or 30% of losses. And they could come back to back to back. And we need to be able to survive that type of situation. Here's the 07 to 08 results. This is how that pans out. So anyways, just thought that was worth taking a look at. You can see this was a struggle here from August to September. It didn't work that great. It's probably like a 50-50, but then it works itself out, and you can see where the advantage comes back in if you can stay alive long enough. But again, this is an outlier when it comes to market data, and this is kind of like a worst case scenario looking at the past several decades of trading. But we still had very close to a 70% accuracy rate with 253 trading days and 176 of them being predicted accurately. All right, so let's get into an example of this. So this is Tesla. I just picked a chart. There's nothing specifically special about Tesla, but I just picked a chart, Tesla, just because I don't typically use this, for example, so I thought I might. So what we can see on this chart, reading it left to right, is that right here, we switch from bearish control to bullish control. And the thing that I want to highlight is once we enter into bullish control here, we stay in bullish control all the way up until the current date, which I think this past Friday was the 22nd. Yep. So this is the 22nd. So once we are in bullish control, every subsequent candle, doesn't take us out of bullish control. We maintain bullish control because there's no bearish candles. There's no red candles that close below the open of the most recent green candle. So this candle, even though it's red, does not close below the open of this candle. All right. And this candle does not either. So it's a red candle, does not close below the open of this candle. There's a trading strategy built into that, by the way, that I'll outline briefly in this video. But the idea is, as we go candle by candle, sitting here on this green candle, we're able to say, okay, I have about a 75% chance that this next candle is going to be bullish in nature. Okay, I have a 75% chance. 75% chance, 75% chance. This just happens to be a really good run. And likely if you go left, you probably see some consolidation where it was more like a 50-50 thing, because that's typically how it happens. The tops and bottoms of these of the markets will the bias won't be as strong, and the edge will not manifest itself as strongly as it does in these big bull runs or big bear runs. But the idea is each day you're going into it just using this analysis, nothing else. You're going into the next day understanding what the bias is. So you go, okay, bullish bias, bullish bias, bullish bias, bullish bias, bullish bias. And again, that's what we're referring to when we say, okay, there's 76.28% accuracy. So what could we do with this? All right. So is it a matter of just buying the open the next day? I'll let you determine if that's something you want to do. That's not what I would do, but I want to break out an intraday chart and show you what intraday charts look like from the period of October 7th to October 22nd, 2021. So during this period of time where we never exited the bullish bias, if we come down to, say, a 14-minute chart of Tesla with just an oscillator, this is the stock RSI, but again, I've removed the red line of the stock RSI as to, we're not looking for divergences or anything for this example. I'm not saying you shouldn't look for divergences in your trading. I'm just saying I'm trying to keep this as simple as possible for this little technique. Again, you can add to it as much as you would like, but I'm just trying to illustrate this is the period on the daily chart where we had a bullish bias. So let's follow what the oscillator does. Under a bullish bias on the daily chart, as the price oscillates intraday, we get to an area of being oversold. And then what does the price do in this period of time as we move from oversold to overbought? Right. So this is where our advantage comes in. As we're following an oscillator that goes from being oversold to overbought and overbought to oversold, we understand that the bias is bullish. So we're more interested in trying to get in trades where the oscillator is oversold and moving from a position of being oversold to a position of overbought, right? But we're wanting to trade to the upside because of the bullish bias that we're finding on the daily chart. And so again, I'm just going through different, what I'm doing is highlighting every single oscillation from oversold to overbought just to show you, okay, was there appreciation in the price? So yes, there was appreciation in the price. Here again, appreciation in the price. Here again, appreciation in the price. Here again, a lot of appreciation in the price. Here is that red candle that we saw. I think it was October 19th. So remember, if we go back to that daily chart, there was a red candle. It didn't take us out of bullish control, but it was a red candle. And that's one of those times where you're looking at this oscillator, you're anticipating the oscillator to go from oversold to overbought, and it does, but you're anticipating for the price to appreciate during that period of time. It worked here, it worked here, it worked here, it worked here. This is not a perfect science. It does not work here, but we're still in bullish control. So the very next time we're oversold again, we understand that the bias is to the upside, and then we get another positive move. Hope that that makes sense. So as we're trading these oscillators, and again, you're combining multiple time frames, you're combining different tools and techniques. We're looking at divergences and tweezers, or maybe not. Again, we'll talk about that more later in this video of you building your own trading strategies, you building your own ways of looking at the market, and understanding that each of us as traders and individuals, we bring different baggage to the market, but we also bring different advantages to the market based on our experiences and different perspectives. So we will not all trade exactly the same. It's just the idea that in its most simplest form, this is a technique that you can add to pretty much any existing technique to very likely increase your odds of ending on the profitable side of a trade. So if we go back to this slide, the first way that I would talk about, possibly trading this idea of understanding where the daily chart is with its probability of the subsequent candle having a bias to the upside or downside. The first way that I would look at trading that is going into those smaller charts, looking at, 14-minute time frames, 22-minute time frames, 35-minute time frames, following the oscillators, and then understanding that we can try to buy relatively low on those oscillators. And it's very likely that as those oscillators move from oversold to overbought, we're going to end up with a profitable result because we're trading in the direction of the bias of the daily chart. So that gives us an edge 76% of the time. Not bad at all. But if you think about how we're doing this, there's also another thing that we can do as well. And I'm going to zoom in to this area right here to show you this, because this doesn't present itself with every single candle, but in this particular instance, it does. And you can see this on the charts quite frequently. So we're going to zoom in here. All right. So we have this green candle that brings us into bullish control. We then have a red candle that does not take us out of bullish control, but it is a red candle, and then it's followed by bullish control, all the way, so on and so forth. But here's something to think about. What we're really saying is when this candle's in bullish control, there's a 76% chance that the following candle does not close below the open of this candle. All right. And possibly for Tesla as a ticker, and again, I have not back tested Tesla, but maybe Tesla has an 80%. Maybe there are some equities that, and I'm not saying maybe, I know for a fact, there are some equities where this works 80% of the time. There's some equities where it doesn't work as well. Typically, the more liquid it is, such as the broad market tickers or big companies like Tesla, Apple, Amazon, Facebook, right? Typically, those work better, which is good because we want that liquidity in our options chains as well. But the idea here is that when we're looking at this green candle under bullish control and think about it, what we're really saying is that the following candle has a 76% chance of not closing below the open of this candle. So what happens if we just draw the open on this candle and then go into the following trading day and realize that if the price dips below the open of this candle, there's a 76% chance that it does not stay below the open of this previous candle. So what does that look like on smaller charts? So this candle is October the 7th. It's October the 7th, and this red candle is the 8th. We're going to need to remember that for the next slide. October 7th, green candle puts us in bullish control. We have a bullish bias going into the 8th, but we know that there's a 76% chance that on the 8th, the price will not close below the open of this green candle. And the open of that green candle is at a value of, I can't read it, 285.47, sorry, 785.46. And so what I did was I drew a horizontal line. This horizontal line is the open of this green candle. So this green candle open is this horizontal line at 785.46. This is the 7th, okay? This is the 7th. This red candle is the 8th, and the 8th starts right here where this vertical yellow line is. So as we look at a 22-minute time frame, we're moving from the 7th, which was the green candle that put us in the bullish control. And as we go into the 8th, we understand we have a bullish bias, and there's a 76% chance that we do not close below this line. So as this oscillator dips to an area of being oversold and the price is below 785.46, everywhere in this area here, so we're oversold, and everywhere under this line, we know that if we buy anywhere in here, there's a 76% chance that we are going to end the day above this line. All right? So what ends up happening is at the end of this day, we do close on the line, essentially, as support, and we stay in bullish control, which means that the next day, we go, all right, there's a 76% chance that the next day, it's going to close above this line as well. And so what we're able to do is understand where the price is and go, okay, this price only has about a 25% chance of staying below this line. So I'm going to go ahead and buy this and know that 3 out of 4 times I'm going to be correct on this trade using nothing else but what I've shown you. It's a very simple trading technique, but at the same time, it doesn't work unless we actually approach the open of the previous candle, which on a lot of these you can see doesn't happen because we're so bullish that it's just jumping, going higher and higher, and we never approach the open of the previous candle, except for this one. This is a good example. I should have highlighted this. This green candle, right? When this next candle opens the following day, we understand that this is a bullish bias candle. It opens below the open of this candle. And so we know there's only a 25% chance that it stays. Sorry, my cursor was on the wrong screen again. I'm sorry, y'all. So this green candle right here, when we move to the next candle, this open down here is below the open of this previous candle. We know there's only a 25% chance that that price stays there. So we can buy, and then it leads to this subsequent appreciation. So that's what that looks like. So now let's just take a look at the Dow itself. Okay, so here's the broad market. This is one of the broad market tickers. We use 4, obviously. So we have the Dow, the S&P, the IWM, and the NASDAQ. And I'm just going to highlight the various areas of bullish and bearish control. Okay, so what happens is we enter into bearish control and we stay in bearish control through this entire period. So as we go candle by candle each day, and this is the Dow Jones, we're looking at the next candle and saying bearish bias, bearish bias, bearish bias. And you can see what ends up happening is, and you can just imagine what the oscillators look like on the 22-minute time frames, the 14-minute time frames, so on and so forth, is as we're in this red candle right here, we're going into the next day going, okay, if those oscillators go high, we're going to sell. We're going to be buying puts or selling short. And you can see based on this wick that the price would have appreciated and then retracted back. Here, the price would have appreciated, nice green candle at some point in time, and then it would have retracted back. The price would have appreciated in the morning and retracted back. This price at some point in time fell and gave us a nice downward move. Then we have another downward move. Then we have a day where there's not a whole lot of downward move there, but at the same time, sometimes our oscillators save us because from the open, you can see that the price went up. So the oscillators were likely from the previous day moving from an area of being oversold to overbought, which we would not have participated in because it's a bearish bias. And then moving into the following day, we're going down again, down again, down again. I mean, this is just money, 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 money. Again, and then we switch. So where you get burned, where you actually are likely to lose, is moving from this candle to this candle because you're entering into this day with a bearish bias, and it's anything but a bearish bias. It's actually switching us from bearish to bullish. And so this candle is where we lose money. But in the subsequent candle, we're now expecting to have a bullish bias. We win. Bullish bias, yes. Bullish bias, yes. Bullish bias, no. We get a bearish bias, but we stay in that bearish bias throughout this 5 candle range. Then we switch bullish. Then we switch bearish, and then we switch bullish. This past week was entirely bullish. And so every time you can just pull your charts up right now and look at the combination of oscillators on the 14, 22. You can even throw a 9-minute chart in there if you want to, and look at what happens when they reach areas of being oversold, especially 2 beside each other. That's one thing we talk about many, many times in the member section, using 2 time frames beside each other, allowing both of them to become oversold, and then selling when the smaller of the 2 reaches an area of being overbought, and then switching from bullish to bearish control if doing an uptrade. So the point of this slide is to say, look, out of 30 to 35 candles, I think it's probably 35 candles, out of 30 to 35 candles, we are wrong with our bias 1, 2, 3, 4, 5 times. So the accuracy rate during this period of time recently in the market is not 75%. It's something far greater than 75%. But the idea, it's something that's, it's greater than 80% over the last, last 2 months or so. So how can you use this? Well, it's a number of ways that you can use this. You can use this to say, all right, possibly you have a trading strategy that's working well, or maybe you're looking at divergences. Possibly you're using the bullish or bearish control lists that I'm sending out each week, and you're trying to figure out how to improve the accuracy. Well, you can apply this technique on the broad market and say, well, I'm going to use the broad market and realize that I'm going to be accurate with my bias about 75% of the time. So if I'm going into a trading day and I understand that my bias is a bullish bias, then I'll look at the bullish control tickers. I want them to oscillate and get to an area of being oversold. And then I'll likely enter into that position knowing that the broad market also has a 70 to 75% of accurately moving in the same direction as myself. Or maybe, because the daily chart is not included in our bullish to bearish bias determinations, because remember, we're using the monthly chart, the weekly chart, the 130, and the oscillations on the 130-minute time frame. The daily is not included. What if you added the daily into that analysis on an individual ticker? The answer to what that would do is that would increase the accuracy of your trades, but it would limit the amount of tickers that would be available for you to trade. So increased accuracy, but a more limited number of available tickers that meet the criteria, because the criteria becomes more stringent. This can be folded into your trading strategy in whatever way that you see fit.